This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. Europe is ramping up its defense spending, and we go to Sweden to see why a relatively small player is punching way above its weight. And private credit was all the rage, but we are learning the hard way that it may not be for everybody or for every situation. Plus, we return to Nepal, where voters have now gone to the polls in the aftermath of that social media-fueled uprising of last year. But we start with the state of the U.S. jobs market, where the most recent numbers point to softening. To give us the perspective of an investor, we welcome back Stephen Rattner, Chairman and CEO of Willett Advisors, responsible for investing the personal and philanthropic assets of Michael Bloomberg, our founder and majority shareholder. Let's talk about the U.S. labor market right now. We have had some numbers now indicating some softening over the last 2 or 3 months, actually. How concerned are you, or should we be?
Well, actually, we've had softening over even the past year. If you look at the number of jobs created on average, it was substantially lower last year than in the previous several years. How concerned should we be? We should be somewhat concerned. It's not a great thing, obviously, to have the unemployment rate going up, to have the number of jobs going down. None of that can be viewed as good. Obviously, you still have had, so far anyway, very strong GDP growth, so that is, in some ways, an even more important indicator. But yeah, it's definitely of concern.
As you say, GDP is growing from the numbers we've seen so far, for 2.5%, 3%, something like that. And we are not creating as many jobs. Is that a shift in the economy about how many jobs we need to have the same output?
Well, obviously, just the simple math is when those two things happen, you get a productivity increase, and that's a good thing. Productivity increases are really what makes the economy more prosperous for everybody. You can't have real incomes go up without productivity growing. In terms of why is this happening, why is this disconnect happening at this time, there are obviously a bunch of theories. One is AI, which we can come back to. But I think it's absolutely true that companies are battening down the hatches. They are nervous about the tariffs. They're nervous about the uncertainty. There was a huge amount of hiring that went on post-COVID when it was hard to find workers. People took whoever they could get, and so they're trying to right-size all that. So I think that's really what's mostly driving this.
Employers are worried about the tariffs, but also they've had to pay tariffs, and it's been a difficult thing to pass all along to customers. So is it possible the tariffs are actually helping on the productivity, ironically?
Helping on the productivity and hurting on the jobs, because basically when companies do have these tariffs that they have to pay and then pass on, they look at other costs and say, what other costs can we cut? And if people are part of it, then they cut the people.
Some of the job growth we've seen has been in healthcare. In fact, a month or two ago, it was all in healthcare. What does that tell us about where our economy is headed? Because we're not really growing jobs almost at all outside of healthcare.
No, in fact, manufacturing jobs were down last month, and they've actually been down pretty consistently over the past year or so. And of course, a lot of people worry a lot about manufacturing. The healthcare jobs, on the one hand, are perfectly good jobs. We need people to be everything from nurses to doctors to whatever in the healthcare system. But on the other hand, you could make an argument they're not really producing anything. They're taking care of us as we get old, as our society gets older, and we need more and more health care. And so we should also want a more balanced job creation picture in which jobs are being created and all sorts of other things, including manufacturing, including services.
How does immigration factor into the labor market at this point, if at all? We obviously don't have the same immigration coming in, and there are some reports that people actually may be leaving the country. Is that affecting the labor market?
I'm a bit of a contrarian on this. The narrative is, yes, it's affecting the labor market, and particularly from people who are pro-immigration. They say, see, we got to have more immigration. And I'm in favor of more immigration. But it's very hard at the moment to see a lack of immigration as the reason here. You have labor force participation going down. You have the number of job openings going down. You have the number of the unemployment rate going up. So you have a whole bunch of other things that suggest that this is just a very loose jobs market. And also, when you look at CEOs on their quarterly earnings calls, they're not saying it's hard to find people. Nobody is saying that at the moment. They're in fact talking about how many people they're cutting.
You mentioned AI. Does AI factor in at all yet?
Well, if you look at something like manufacturing, I think pretty obviously it doesn't have anything to do with why we're losing manufacturing jobs. I think it is having at least some anticipatory effect in the sense that companies are saying, we don't need to hire as many engineers this year because we're going to have AI doing more of this stuff. We don't need to hire in the financial services world as many new entrants into our into our staffing because we're going to have AI doing more of this stuff. So I do think it's having an anticipatory effect, although I'd be the first to say I don't think it's actually changing the number of people working at the moment.
As an investor, how do you take into account the labor market? How does it affect how you position your portfolio?
I don't think the labor market per se is really that much of an issue for us. I think we would worry about a couple of things. One, the overall state of the market, and when you have rising unemployment and rising inflation at the same time, which we may have, we're going to get a few more reports, then that's getting perilously close to stagflation, and that is really bad for the market. The Fed, it's bad, it's tough for the Fed, it's bad for the market, and so forth. And then there are certain sectors, particularly software, where the anticipatory effect, again, of AI seems to be the greatest, and so it becomes fairly perilous to work your way around the stock market under that circumstance.
Stagflation is the thing that all economists say we have to avoid. That's really dangerous for us. What can we do at this point? By we, I mean the government or private industry. What can we do to really avoid the risk of stagflation?
Getting rid of the tariffs would certainly be a good start in terms of reducing costs for business, and therefore they don't have to raise prices quite as much. Beyond that, I'm not sure in the short run there's that much we can do. In the longer run, you want to have a more flexible economy, you want to deregulate, you want to try to make it more competitive, things like that. But in the short run, you sometimes get in this box that we may be heading toward.
What does this mean for the Fed potentially? I mean, how do they address this? We're going through a transition, obviously, with the chair of the Fed, but how do they address this situation where we do have growth, we may have a softening labor market, and there's concern about basically inflation at the same time that we have slowing growth?
It's tough for the Fed. They have a dual mandate, as you know, where they have to focus on both unemployment and on inflation, and so you can't necessarily do both things at the same time. There's a Fed meeting in the middle of March. The anticipation of further rate cuts this year has already dropped a bit in part because of the war and the effect on oil prices and how that's going to pass through into inflation. And so the Fed's going to have a tough decision. I think it's highly unlikely, almost implausible, that they would raise rates at this point. The question is, how much do they cut them? It had been expected they would cut them twice this year. I think that may become one. It may become none before we're done. But that's the range of possibilities.
There's some nervousness in the market these days about private credit, which sort of is an adjunct to the AI investment that we have. Is it a real problem as you look out at the credit markets? Do you think there's a real issue there?
I think there's definitely going to be some pain. I think there were a lot of loans made to particularly software companies, what we call ARR loans, where they were made annual recurring revenue. They're made on the basis of revenues as opposed to profits. Since revenues don't necessarily mean you're solvent, they just mean you have revenues. And so those kinds of loans, and this happens in every cycle. I don't mean to be blasé about it, but it happens in every cycle. So I don't worry too much about private credit. There's going to be pain, but the system is not as leveraged and not as sort of badly engineered as it was in 2007, 2008.
You've got investments that you don't get mark to market every single day.
Oh, yeah. Yeah.
So how do you make sure that you get the right data? I mean, we see that in all sorts of places, including China. Sometimes people say, I'm not sure if the data coming out of China is reliable. How do you know that your risk data is reliable?
We don't necessarily know it on a day-to-day basis, but we watch the companies carefully. We have an idea as to what would be good or bad for them. And we do get quarterly marks, and we get financial statements, and so we can try to analyze the quarterly marks and see if they're accurate or not. But given that they're private investments, there's not usually a whole heck of a lot we can do about it anyway. And so we just try not to make new mistakes and live with our old ones.
We have a new risk right now, which is the war with Iran. Has that taught us anything about safe havens? I mean, if you look what's happened to the dollar and what happened to the U.S. Treasuries, it's interesting what's happened, actually. Treasuries sold off to some extent. People went to the dollar. Are the nature of safe havens changing?
That's a great question. I think the dollar is a safe haven, and most people see it, and as you said, that's probably what we've been seeing. I think treasuries are more complicated because the war creates inflation, and inflation is bad for treasuries. And so you could argue that that's why treasuries should sell off in this set of circumstances. But it's been an odd situation because gold until recently and silver also until recently have been so strong that those are normally indicators of a lot of fear out there in the market. But the market has been pretty stable, even with the last week or two of commotion. It's been pretty stable, all things considered. So it's something people have been puzzling over, which is why, on the one hand, why people have been going to these things like gold, but on the other hand, they still appear to be very much invested in stocks.
Up next, Europe rushes to get up to speed on defense spending. And a surprising leader in the effort is one we don't typically associate with supplying arms. This is a story about punching above your weight. For decades, Europe relied on America's military might for its security, confident that large-scale war on the continent was a relic of the past. Russia's invasion of Ukraine changed all of that. Now, Europe is increasing defense spending, rebuilding industrial capacity, and getting ready to enter the arena on its own if it needs to. And it's looking to the traditional leaders, such as Germany and the United Kingdom, to step up. But it turns out that there's a smaller country playing an outsized role, one that might surprise you. When you think of Sweden, you might picture snow-covered streets, minimalist design, maybe even IKEA or ABBA. Defense manufacturing probably isn't the first thing that comes to mind, but maybe it should be. Here at Saab, production has been ramping up. The company reported record orders on the books, and it's not just fighter jets. Saab builds everything from missiles and radar to surveillance systems and naval platforms, capabilities few countries sustain domestically. CEO Michael Johansson describes the magnitude of the new demand.
I think if I look at our company, we have probably 4 to 5-folded output for like before the war started. So lots is happening, and I think we are underestimating the capacity of the European defense industry.
For a country of just 10 million people, that's significant. But the phenomenon is not uniquely Swedish. European defense company stocks are surging, with other major players like Rheinmetall and Leonardo reporting record years along with Saab. 4 years into the war in Ukraine, the demand driving those record numbers is no longer just crisis support. It has become a broader story about Europe's new security posture. A story echoed across the Atlantic as President Trump pushes NATO allies to spend more.
We were paying for almost all of NATO. Now they're paying for it as opposed to not paying for it.
It's a wake-up call. The European people know that we will have to stand on our own feet, be more independent.
Anders Fogh Rasmussen is the former NATO Secretary General and Prime Minister of Denmark.
For too long, we have relied on a combination of cheap energy from Russia, cheap goods from China, and cheap security from the United States. That model doesn't work any longer. Now we have to stand on our own feet. We need to shift gear. We will need to make Europe a defense superpower.
But not every country is willing or able, according to economist Jacob Kierkegaard, a senior fellow at Brussels-based think tank Bruegel.
I know we say that, Europe is rearming, but the reality is that Europe as a whole is not rearming. There is a limited number of countries that rearm. That includes at least 2 big ones. First and foremost, of course, Germany, the other one being Poland, and then a number of smaller countries, particularly in Scandinavia and other parts of Eastern Europe. And these are countries that actually do have, if you like, latent fiscal capacity. Germany, again, being the case in point. And therefore, there is a self-selection. The countries that can have both guns and butter, well, they're rearming. But those that had to choose, and by that I mean France, Italy, Spain, the UK, they are much more hesitant when it comes to significantly increasing defense expenditures.
Defense has the potential to become a stronger economic driver across Europe. The EU is targeting 50% of defense procurement to be from EU suppliers by 2030, a meaningful shift considering that after Russia's invasion, that number was roughly 25%. But meeting that goal requires production capacity, and that's where Sweden stands out. It has maintained that production capacity for the better part of a century, in part because it historically relied more on exports than other European manufacturers, and that continuity matters. There's a, I would say, dramatic ramp up into spending right now, but there were years where there was not as much attention or investment in Europe in defense. How did Saab maintain its investments?
Well, we have never sort of dismantled sort of everything, as you are alluding to, within our company, and that goes back to our ownership, I think. Even though we are a stock exchange company, publicly listed, we have a strong owner in the Wallenberg family. And they have always been long-term and also very loyal to sort of the deterrence and defense of Sweden for many, many decades. And so we never dismantled. We continuously invested more on our own, I would say, when sort of the government didn't sort of fund everything that we wanted them to fund. And we have always been a company that takes sort of a lot of our top line and our bottom line, for that sake, to reinvest in R&D, to always be relevant in the short time frame, but also long term. So we are a bit unique in that sense, I think, not only looking at relying upon governments all the time to keep our operations efficient and state-of-the-art.
Sweden has been ready to step up on defense, and its entry into NATO in 2024 sealed the deal. As you described, Russia's invasion of Ukraine triggered an awful lot within the defense industry. It also was a wake-up call for Sweden as Sweden joined NATO. How has that affected Saab's business, if at all, Sweden's being in NATO now?
For the company, I would say all of a sudden we are involved in the common acquisitions that NATO is doing now and then from the acquisition authority within NATO, NSPA. And of course, we're much more involved in understanding where NATO is going in terms of capabilities needed short and long term, which we were actually outside, not having an insight into. We didn't come into play when it comes to acquisitions before we joined NATO, really, or when we became an invitee. It's completely different now. We have framework contracts with NATO, so we get contracts from that organization. We understand what we can be offering going forward. We work better with the alliance capability transformation organizations. So this is a big shift. And of course, it comes down to now we're a country that can be relied upon long term because we are in the alliance, and with that comes that Saab is long term trustworthy as well.
Expanded access to NATO markets brings opportunity, but it also brings pressure to scale production, invest in research, and carefully manage capital.
I think we've managed our sort of operational capital and also our capital employed in a very good way while we are sort of investing 5 times more in capacity building than we did before the war. We are investing heavily in R&D, but still we have a strong, solid balance sheet. And that is, of course, about sort of making sure that you have contracts that gives you continuous cash flow, but also that some customers are prepared to give you some advance payments so we don't have to act as a bank. So there's still more to be discussed with governments, but so far, capital-wise, we are doing well.
There was a time when in the United States, and I think in parts of Europe, there was a sense that investors, particularly institutional investors, were reluctant to invest in defense. That seems to be changing now.
It's been a big change on that side. I mean, I remember in January 22, shortly before this tragic war broke out, we had lots of discussions in Brussels about what we call the taxonomy and if this was a sustainable business, which was crazy in the way I see it, because I mean, if you have politicians saying you have a threat environment and we decide as a country that we need a defense force, of course you have to have professional and strong defense industries to create that strong defense. But that was a strange discussion about this type of business were not sort of sustainable, and investors wouldn't get an eco-label sort of stamp on their funds if they invested in defense. That, of course, sort of disappeared more or less completely, not all of it, but lots of it, when the war broke out and we realized that we had to catch up. So, I mean, if you look at Saab, I think we were 45,000 shareholders before the war broke out, and we are 300,000 shareholders as we speak. So it's been a big change in the perception.
And it isn't just Saab's shareholders who are backing the ramp up in defense production. The Swedish government is right there with them, as explained by Finance Minister Elisabeth Svantesson.
It is definitely a boost in the economy. We have 6% this year of GDP in different public investments. I think we are in the top in the EU. And of course, defense spending is one of the big investments. And we have this defense industry, it's strong. So that's important. And what I think a lot about is how could we do that? I mean, this will change the labor market, the economy. How can we have the synergy effects, and how can this will affect the labor market, the economy? How can we do it in the best way? Innovation, technique development, and so on. I mean, we are raising double defense spending just now, and it will be more. That in itself is helping, because much of what will be produced in Sweden or in Europe, of course, and so we are helping that way.
But not all European financial institutions are as supportive of the move into defense spending, especially when it comes to multilateral lenders like the European Investment Bank.
I think much too little has been done. I know that the European leaders, when they meet in their biannual or every quarter, every time they usually have a sentence that says, "Oh, the EIB and other multilateral lenders should do more." But we're 4 years into this war, and the direct funding, for instance, from the EIB and other multilateral lenders to European defense is very limited. The direct involvement also of, say, European pension funds remain very limited. And I think that is, quite frankly, a clear policy failure, and what I would call initial executive institutional inertia. You have not had leaders in these institutions, both the policy institutions and the private sector institutions, to basically push this. I think it's a mistake, but it obviously hasn't prevented private capital, venture funding and others from flowing into the sector. And with the equity valuations increases that we have seen, the increase in European funding, venture capital funding in the sector as well, but it has been largely despite the traditional pillars of the European financial system in the large banks, in the pension funds, and in the policy lending institutions of the European Union.
And that may be an important reason why Sweden is punching above its weight when it comes to defense. A combination of being prepared, having the support of investors, and recognizing an urgent need. Coming up, looking for and past the cracks in private credit.
I get nervous anytime any particular strategy gets a little bit crowded.
Where it's just what is needed and where it may not be. This is a story about one size not fitting all, particularly when it comes to risk. Private credit has become all the rage over the last few years, with some of the largest alternative asset firms catapulting themselves into managing hundreds of billions of dollars.
They've done, very, very well over time, built big businesses.
And the growth in private credit isn't limited to the United States.
They need private capital. They need risk-taking. We're seeing it in Germany, and we're seeing it here, where Japan is just more hospitable to private capital.
But in recent days, the shine on private credit has come off after some people have had trouble getting their money out.
Shares of KKR and Blue Owl were down as much as 10% yesterday.
And I think we're seeing the first sign of stress around these funds.
Although the lending is private, concerns about the industry have made their way into public markets, with shares of Blue Owl, Apollo, and others under pressure.
I get nervous anytime any particular strategy gets a little bit crowded.
Andrew Junkin invests in private credit as Chief Investment Officer for the Virginia Retirement System. He oversees pension assets for 230,000 Virginia public employees and allocates about 16% of their $130 billion to private credit.
I think the capacity for the private credit markets to absorb the growth that has happened and that is forecasted to continue to happen is probably pretty solid. It's not the highest expected return asset class that we have. That would probably be private equity, but it is higher than public fixed income, which for us is really investment grade. I mean, that's kind of the sleep at night, treasuries, agencies, investment grade corporate portfolio. Private credit has a little bit more credit risk in it, of course, but the yield is higher, and we're expecting returns kind of in the 7, 8, 9% over the long term. Right now, we do think that private credit has expected returns that are a little bit higher, which is one of the reasons in the short term we've been sort of increasing our allocation.
Marcy Frost is CEO of CalPERS, the largest public pension fund in the United States.
On the private credit side, we've been very specialized and working only with, high quality managers. We had a 8% allocation to private credit, and I think we're hovering around 4%. And we believe that book is diversified enough that, the team is really not too concerned about the software exposure.
For regulators, dramatic, rapid growth in any asset class often raises questions.
Anytime an asset class grows very quickly, in absolute amounts, but also profitability, it should invite closer scrutiny. It doesn't mean it's necessarily problematic.
Dan Tarullo served as a member of the Federal Reserve Board from 2009 to 2017, with particular responsibility for bank oversight. He's now a professor of law at Harvard.
Well, there are certainly risks, David. I mean, the way I'd put things now is we should be on yellow alert. Not red alert. The story about private credit, which is to a considerable extent the right story, is that it's filled in a gap that banks either never quite worked in traditionally, which is providing funding of certain sorts in leverage buyouts, private equity transactions, but also kind of moving into some other areas because of some of the advantages that they have and also because of capital requirements for banks. So if we take that as a starting point and say, okay, for regulatory and business reasons, banks aren't in some of these spaces, private credit moves in. It's not as though the banks are now totally out of the exposure, because banks have been providing and do provide a substantial amount of backup credit lines for private credit funds. And thus the exposure of banks is indirect rather than direct, but indirect exposure can be just as damaging as direct exposure.
JP Morgan just this week decided to limit its indirect exposure by restricting lending to some funds. The degree of risk in private credit depends, of course, on what you're comparing it to, a point Apollo's Mark Rowan knows all too well.
And it's de-risking for individuals because people are not funding their investments in these BDCs with their treasury portfolio. They're selling their equities. Last I looked, first lien debt is senior to equity. They are making an intelligent decision that they can earn equity-like returns without equity-like risk and take money off the table.
I mentioned that public equity is about 32% of our portfolio and that private credit had moved up, or credit strategies had moved up. Actually, the funding source for that had been largely public equity. So for us, it was kind of a relative value trade.
Whatever the comparison, managing the risk in private credit is critical, as in any investment. That's a major theme of Lloyd Blankfein's new book, Streetwise, about his career at Goldman Sachs. He describes Goldman's risk management system based on marking assets to market daily, something that's difficult to do with assets like private credit that, by their very nature, don't change hands regularly. But something Apollo Global Management just announced it was moving toward.
It's illiquid. I mean, it's illiquid for good reasons. If you're financing lending somebody $200 million on something, and you want to sell 10% of it, who's going to do the credit work on such a small piece? And you just don't have the liquidity to see it. And I would say a lot of the people who are doing this, running these portfolios, will say they are marking them. But how do you mark it?
Tarullo agrees that the illiquidity of private credit makes it more difficult to keep valuations current, but he also has other concerns.
One of the things that worries me here is that the information gaps we have aren't being plugged to the best of the ability of the regulators. And you know, if they did that work, we might all be somewhat reassured. I suspect we'd probably find some issues and problems that need to be dealt with. But it's both the opaqueness of the valuations of many of these investments, because you know there's no price discovery for these illiquid loans, and the fact that the regulators are not helping the rest of us poke through that opacity and figure out exactly what is going on.
While concerns about the risk profile for private credit are on the rise, others point to its strengths, in spite of the recent market turmoil.
Obviously, some companies have some credit issues, and either they get refinanced or in some cases they get reorganized. But by and large, I would say the default rate has been lower than has been expected historically. And so the returns have commensurately been probably a little bit higher.
Making sure that private credit is the right investment depends every bit as much on who's doing the investing as it does on the nature of the credit being extended. What may make sense as part of a large portfolio for an institutional investor may be wrong for retail investors saving for retirement.
One of the biggest advantages of private credit has been that the capital is tied up. That means there's not liquidity for the investors, but it also means that the private credit fund has a very good sense of when it's going to face redemptions and how much capital it has available. As the private credit people have tried to move more and more into retail, we've seen this liquidity. This is the liquidity issue that's blowing up that you referred to earlier. Retail investors just don't think in terms of long-term investments, and they can't get their money out no matter how badly the underlying investment is doing. But a little bit of liquidity is not the way people who are used to investing in stocks and money market funds and ETFs, it's not the way they think about it. And that limitation on liquidity, I think, is a lot of what's putting the pressure on at the retail level right now.
We have the potential for individual investor behavior to create some mismatch between the structure and the underlying investments in the structure. So think back to the global financial crisis. I think a number of academic studies afterwards showed that individual investors in 401ks in many cases panicked and de-risked kind of right at the bottom of the market. And if there's a big run to sell, whether it's private credit or private equity, when prices are down, I think that could create some challenges for that market to function efficiently and effectively.
It's not any more likely that a security will be good or bad in the hands of a retail person versus an institution, but the consequences of it being wrong and being bad from a political, sociological sort of way are much worse, because the political sector can watch with interest but not much action if big institutions and very high net worth individuals lose money. But if 401k plans start to lose money, individuals that were brought in late in the cycle, you know, there's going to be an inquiry or an inquisition that will follow this.
As Tarullo says, it's not time for a red alert yet, but the worst-case scenario for private credit might not be what we are expecting.
What I regard as the bigger risk right now is not so much financial stability, it's more macroeconomic. That is, how much leverage is there totally in this system? We know there's leverage by the companies that are borrowing from the private credit funds, but are the investors, to what degree are the investors in the private credit funds also borrowing? To what degree are the private credit funds themselves borrowing? And once you really need to have that sense of how much leverage is there, and you need to have a sense of what would happen if the investments into the private credit funds dried up so that they could no longer make the kinds of loans that they've been making. Under those circumstances, I would expect that banks and other providers of credit could step in to some degree, but I don't think they'd be able to fill the hole entirely. And so you'd have the same kind of problem, a concern that you have when banks are encumbered because of losses. They can't make more loans, and you're denying credit to creditworthy households and businesses. So as we sit here today, I'm actually somewhat more concerned about the macroeconomic impact of private credit than the financial stability or macroprudential impact of private credit.
Up next, we turn to the high Himalayas to revisit the aftermath of that social media-fueled revolution in Nepal and what it says about uprisings across the globe. This is a story about moving mountains. When and whether the power of the people can shift the tectonic plates of governments around the world. Late last year, we brought you to Nepal, where an idea about fairness spread across the nation and helped bring down the regime. This past week, the sweeping changes continued as the mayor of Kathmandu headed to a landslide victory to be the country's next prime minister. To understand what's happened, we have to go back to the beginning. Our colleague Michael McKee takes us to the high Himalayas for the anatomy of a revolution.
We plan to have a very small, peaceful protest.
Did you stay off of social media or did you go back to posting?
No, I went back to posting. I will never stop posting. It's fine, even if I die.
Now more than ever, people have a window into the lives of others. Social media connects youth across countries and continents, but it also shows them riches beyond their reach. And as inequality and unfairness become more conspicuous, some Gen Zers have taken to the streets. In Nepal, a small democratic country wedged between Tibet and India, what started as a few angry posts became a movement that overthrew the government.
We were marching towards the parliament gate, and I was always very opinionated. I used to have opinions on everything. I was a rebel kid. This video is about me asking.
Prashamsa Subedi is a 22-year-old law student who lives with her parents in the outskirts of Nepal's capital, Kathmandu. Not long ago, her life took a surprising turn.
It was 2024 when I started uploading the videos about my political opinion, what I felt the government was doing wrong, and that's when it took off.
In late June, after a Nepali politician downplayed the country's poverty, Subedi posted an angry response on TikTok. A day later, her clip had over 1 million views.
How can a leader, mantri say that? Before, when we think of it, these politicians would not have their life public. So we would not know what their lifestyle was, how everything was going. But then there is a very famous politician. One of his family members was a vlogger. And she used to document their lives, and every clip used to go viral. And people used to see what lavish lifestyle they were having, which we could not even imagine. So that is how it all sparked, that is how it all triggered.
There's sudden visibility to how much richer the rich are than the poor, right? That ability to kind of see over the palace walls.
Clay Shirky studies the effect of social media on politics at New York University.
In revolution after revolution, there has been some sudden change in perception of how the wealthy are living. In Nepal, it was around this idea of Nepo babies, right? It was the idea that the children of the rich were not suffering the way the rest of Gen Z was.
Something had changed about the way Nepal's youth saw their country and the lives of its wealthiest citizens. It was not just the inequality that felt wrong, but the inequality of opportunity. The idea that those at the bottom would never have the chance to rise up, and those at the top might not deserve to be there at all. As the online furor grew, the government made a dramatic decision.
And Nepal has cracked down on a number of social media platforms, including Facebook, YouTube, Instagram, X.
I was, first of all, utterly hopeless and helpless.
18-year-old Shaswat Lamachan was one of the many Gen Zers who was angry about the social media ban.
Talked with some activist friends, figured out like what we could do, and we concluded that doing a protest would be the best way to do it.
Lamichan says he expected 200 protesters to show up. But across the country, others like him were putting out the same call to friends and influencers.
The collective action problem is if one person goes to the government and is protesting out front, they are completely helpless. But if 1,000 people do, they have to pay attention. And if 10,000 people do, they're overwhelmed.
Tell us what happened on September 8th when you woke up in the morning.
I didn't sleep that day.
We all planned to wear school dresses so that police could not even beat us because it's illegal to beat school children. And we were 100 meters away from Parliament where we were sitting, and we got the sense of tear gas.
In an instant, everything changed.
That is when I got the news of a person being killed. We didn't think it would go that far, but there was a news of a person being targeted. I was just scrolling through the news. I could not work. I could not do anything. I was just scrolling through the one scroll, one death. One scroll, one death. After the news that one person is shot and he's dead, I felt so guilty because he might have come watching my videos. So maybe I am responsible for his death.
Police firing echo shots at children dying.
News of the violence traveled quickly, and then escalation.
The very clip that I would say that ignited the fire in the people was a 17-year-old getting shot on his head.
Our palaces were burnt, our banks were looted.
By the end of the violence, over 70 people had died, 2,000 injured. On September 9th, one day after the protests began, many of Nepal's top leaders resigned, including the Prime Minister himself.
We never imagined this situation. It was like nobody told us we would be a country without a government.
But then, an unexpected phone call in the middle of the night.
The army invited us to sit down with them at the army headquarters to talk on what to do next, what the future of the country should look like.
Subedi also got the army's call, along with a handful of others. The ask, you helped start this, now come fix it. Lamichan, who had started a chat room to organize the protests, helped create another, this time to pick a new leader. The name they chose? Sushila Karki, a retired Supreme Court justice known for fighting corruption and supporting women's rights. Subedi, the law student, got her phone number.
She was asking if we were okay and everything, and we asked her to step up, and then she said, if you guys are trusting on me, then I will have to step up because it's not about me anymore, it's about the country.
For Subedi and others, a look over the palace wall made them angry, but then also hopeful for a better future. Hopeful enough to take action, and now hopeful that their action will be worth the sacrifice.
On March 5th, Nepal's citizens took the next step toward delivering on the changes they sought last September, going to the polls to elect a new prime minister. We spoke with Thomas Carruthers, chair for democracy studies at the Carnegie Endowment for International Peace and a leading scholar on democracy and governance globally. He finds the results dramatic.
The March 5th election in Nepal looks like a pivotal moment in Nepalese political history. After the huge demonstrations of last September, which pushed for really dramatic political change, voters have delivered that change. Coming to power as prime minister, bringing with him the RSP party, is Balendra Shah. In his mid-30s, he's the former mayor of Kathmandu. The news makes a lot of him as an ex-rapper, but let's not forget the fact that he's been mayor of the capital city for almost 4 years. He comes in, interestingly, as a centrist. RSP is a centrist party, but comes in with a mandate for sweeping reforms. Nepalese voters are highly dissatisfied, angry. They want change.
So what do we know about his policies from his time as mayor or what he has campaigned on in this election?
I think we could call him, at least he tries to be a sort of technocratic activist, if you will, an activist who tries to focus on good governance, transparency, kind of basic governance reforms. He's not coming for change from the left or from the right, but really from the middle out, which is, I think, appealing to the many youth who protested last fall, who represent a kind of non-ideological movement, a sort of post-ideological movement, which is characteristic of so many of the Gen Z protests that we've seen in the last year.
The story in Nepal has caught a lot of attention around the world with the social media phenomenon and then the uprising that came after that. From what you understand of Nepal, might that have similar effects in other countries?
Over the last 12 months, we've seen a wave of what quickly got to be named Gen Z protests. We've seen them in Africa, in Kenya and Madagascar. We've seen them in other parts of Asia, like Indonesia or the Philippines. We've seen them in the Middle East with Morocco. We've seen them in South America with Peru. All these protests have a couple of things in common. Dominated by young people, often kind of leaderless in their form, rather spontaneous, somewhat non-ideological, very delivery-oriented, here's what we want, and nonviolent for the most part. So these protests have certain common characteristics, and they have the same kind of drivers. Corruption is just a big issue among young people in all of these regions, all of these countries. Corruption is a big thing. Economic grievances are important. And again, that general sense of underrepresentation. And this is, of course, the issue with so many struggling democracies around the world, citizens losing their patience, wanting to see that, having political and civil rights also brings them some benefit to their everyday life. It's not just in the developing world. I think people feel it in many, quote, wealthy established democracies as well.
All of this happens against the backdrop of the war in Iran right now, a very, very different country where Nepal is very, very small. Iran is very, very large. It's something like 90 million people, the size of much of Western Europe. We had seen some uprisings, civil uprisings in Iran before this war happened. What do you think the effects may be on the young people of Iran of what we're seeing right now?
Well, the young people of Iran stood up incredibly bravely in December and January and were massacred by the thousands by just really an amount of violence we have not seen against protesters anywhere in the world in the last 10 or 20 years. Inevitably, Iran is driven by its own political dynamics, but I think many young people in Iran were inspired somewhat by this wave of what I described as Gen Z protests around the world. So maybe not Nepal specifically, but it was one part of a larger wave, which I think many young people in Iran feel they would like to be part of and would like to see the ability to have a voice, to bring to power someone who listens to them and tries to respond to their needs and interests.
Next, how the rest of Europe may go to school on Ukraine's approach to defense. Russia's war against Ukraine has triggered a strong response from Europe, which worries that it could be next. But it's not just Europe that is helping Ukraine. It also goes the other way. Ukraine's experience could help Europe defend itself. And that expertise may even help the United States as it seeks to defend against drones from Iran. Our special contributor, Chrystia Freeland, serves as an unpaid economic advisor to President Zelensky.
Something that I think is underappreciated is the extent to which Russia's war against Ukraine, Russia's full-scale invasion of Ukraine, has been aided and abetted by Iran. Iranian Shahed drones rain down on Ukraine every night. So for the Ukrainians, knowing how to counter Iranian drones is something they are extremely expert in. And I think today, as those of us who don't live inside Ukraine are starting to realize we too could be vulnerable to drone attack, that Ukrainian expertise, more than 4 years of being attacked by Russia, of being attacked by Iranian drones, and figuring out how to defend themselves against it, is the kind of expertise a lot of countries in the world are going to be looking to take advantage of.
As you talk about, Chrystia, it occurs to me it may be part of a larger story here where Ukraine, very unfortunately, is being forced to defend itself, really existentially, and getting battlefield experience that a lot of the rest of the world's not getting.
That's exactly right, David. And, in talking to European leaders, in talking to European and American generals, in talking to European and American defense sector investors, what I've heard from them over and over again is the cycles of innovation in Ukraine are astoundingly fast. And the connection between the people who are inventing and making the weapons and the people who are actually using them is incredibly close. You know, very often Ukrainian brigades manufacture their own weapons. And when you think about it, you know, if you are in charge of designing a drone, if you're sitting at a desk next to the people who are going to be firing those drones, you're going to get pretty good at innovating fast, at understanding what they need, and also at understanding how to fix any problems in your first version of the product.
Saab CEO Michael Johansson says that Ukraine's response to the Russian invasion has changed the structure of the defense industry more broadly. The war in Ukraine has certainly triggered a lot of attention as well as spending in defense in Europe. Does it also expand potentially out the number of players in the defense world? Because we've seen, for example, the use of drones, you know, by startup tech companies. Does the number of defense or dual-use players expand dramatically?
Absolutely, and but even though I'm really impressed with, if you look at Ukraine, how they have done this in terms of more or less delegating, if I simplify it, the mandate to the front for them fighting and having contacts directly back to the industry to make sure that they get upgrades all the time and have drones that actually can sort of accomplish being in that difficult signal environment that they have at the front. That cannot just be copied into any other Western defense force, but you can think about agility and work with the startups in a way that you get more continuous upgrades of capability, and you work in a different way with volume and quantity. So we have a lot to learn from that, and there are many more players in this area now than we saw just a few years ago. Some will make it all the way, but some will also be sort of attached to us as primes. So we will work much more in an ecosystem where we embrace technology in a different way that we've done before. It's not going to be everything invented within Saab and the other primes. This is an important change also in the ecosystem of companies, because there's so many dual-use companies now that want to be part of the defense offerings, but they can't really do that on their own. So we have a big responsibility as primes to attach them to us and work with them to give the end users the best technology and the best capabilities to a large extent. What we lack in Europe is, I think, cohesion on some important areas where we have to work together to create scale.
Europe is rearming to potentially fight Russia also in the future. What is the guidepost here? Well, it is, of course, what works on the battlefield of Ukraine right now. And there, the dominance of drones is very, very important. So I do think you're going to see in the coming years, led by drone companies in Ukraine, because they simply have by far the best technology, in my opinion. So they are going to be integrated into existing European companies. Some will be independent, some will probably be bought by US companies. But the broader role, therefore, of Ukrainian defense producers also as a core part of this sector in Europe and this growing sector in Europe is going to be absolutely critical going forward. And again, on the issue of drones, there's no doubt that domestic development of that technology in Ukraine will, both from a technological point of view, be key, but also price points. You know, when we hear and know that some of the earlier donations of US drones, Swift Blades and others to Ukraine, these drones cost $70,000, $80,000 a drone. Meanwhile, functionally similar Ukrainian domestically produced drones might cost $500. Right? So the key is, in my opinion, to ensure that the Ukrainian defense production sector is operating at full capacity. This is partly because Ukraine is a much poorer country than the rest of Europe. So just from a sort of purchasing power parity point of view. It's cheaper to produce in Ukraine. But it's also from the point of view that what Ukraine has pioneered, partly because of necessity, of course, is you need weapons that are good enough. You don't need weapons that are the best of the best of the best of the best. You just need weapons that are good enough to hit targets in Russia. And that can be quite a lot cheaper to manufacture than some of the specifications that, for instance, European or US producers have gold-plated their development with in the past. So integrating Ukraine, in my opinion, is absolutely key to lowering costs. And it's much more important, and I think this is particularly important to understand in Brussels, where we sit now, this is much more important than having common European procurement of military goods. Because if it was really true that a single defense budget was key to cheaper weapons, well, then the United States would have the cheapest weapons in the world. And that's certainly not the case. So it's much more important to get the cheapest producers and the cheapest technology, which comes, in my opinion, overwhelmingly from Ukraine, brought to the fore, than focusing on ensuring that there's common procurement by one entity, of course, located here in Brussels, which is why people in Brussels tend to prefer these things. But that's not the key to getting, quote unquote, bang for your buck.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.